YEONG, matrix number 161989. My study is titled Smart, Sustainable, or Standard, a performance analysis of AI, ESG, and traditional balance index under the supervision of Dr. Yi Pearson. This study explores how new investment themes like AI and ESG are reshaping portfolio behavior, especially during crisis. With ESG investment reaching over 30 trillion in 2022 and AI driving smarter decisions, investors are moving away from traditional balanced portfolio. Global events like the COVID-19 pandemic and the Russia-Ukraine war have shown that AI and ESG portfolios react differently to shock, which is sometimes resilient, sometimes volatile. Therefore, I focus on three key questions, which is how do returns spill over from traditional portfolios behave in crisis? Are AI and ESG portfolio net return transmitter or recipients? What role do predictors like inflation or geopolitical risks play in forecasting this spillover? This study builds on 3 areas from the literature. First is interest rate. When interest rates go up, traditional portfolio usually perform worse. As a result, investors often move their money into long-term growth options like ESG investments. Second is inflation expectation. When people expect price to rise, it creates uncertainty. This causes investors to leave traditional assets and look for safer options such as ESG and AI portfolio. AI also help investors better predict and manage inflation risks. Third is market volatility, which means how much the market moves up and down. When fear in the market rises, which measured by the VIX, investors often switch from the traditional assets to ESG and AI. AI portfolios react quickly because they depend on real-time news and algorithms. 4. Economic policy uncertainty makes the market more unstable. In such time, investors prefer safer assets. ESG companies with strong leadership are less affected, which makes them useful for reducing risks. Is equity market uncertainty. When markets become unstable, investors turn to faster decision-making tools. AI models are preferred for their agility, while ESG portfolios often receive inflow due to their resilience. 6. Is inflation disease volatility. During health crises like COVID-19, AI-driven strategies perform well due to their speed and adaptability. Meanwhile, ESG portfolios attract inflows as they are viewed as a safer havens. 7. Is climate risks. ESG portfolios tend to absorb shock and perform better during environmental stress. Integrating AI with ESG can further enhance risk management as climate concerns go. Lastly, geopolitical risks. During conflict or political instability, investors often shift capital away from traditional assets and into ESG and AI. AI also plays a growing role in managing geopolitical risks, especially through cybersecurity applications. These factors help explain when and why investors turn to thematic strategies. This study uses a quantitative approach with daily time series data from January 2, 2020 to December 31, 2024, by applying FA model to measure return transmission between traditional, smart, and green balanced portfolios. From 2020 to 2024, the total spillover index reveals stronger return linkages between traditional, smart, and green portfolios. This means that during major shocks like COVID-19 and the Russia-Ukraine war, smart and green portfolios did not provide expected protection. Instead, they moved closely with traditional assets, which confirmed that diversification benefit was significantly reduced during crisis periods. Global events like wars, rising inflation, and interest rate hikes have caused stronger return connection between traditional, smart, and green portfolios. This shows that markets are now more closely linked than before. Even though the total spillover index dropped slightly at the end of 2024, it's still higher than before 2020. This means the way investments are connected has changed for the long term. As a result, investors can't just depend on the old way of diversifying their portfolio. They now need to use more flexible and responsive strategies to handle global shock effectively. Looking at the net spillover index, the balanced portfolio stays as the main sources of return movements. It consistently sends returns to both the smart and green portfolios during major events like inflation and interest rate hikes. The green portfolios had more mixed pattern. At the start of COVID-19, it was a net transmitter because investors were interested in sustainable assets. But in 2021, as confidence in ESG score dropped, it became a net receiver. It then returned again during the Russia-Ukraine war due to the rising green energy interest, but later turned back into the receiver during the Israel-Hamas conflict as investor trust in ESG fell. The smart portfolio driven by AI was mostly a net receiver which reacted to news and market sentiment. But by the end of 2024, it started becoming a net transmitter, which showed that AI strategies were starting to influence the market more strongly. In short, each portfolio plays different roles in different times. This shows that why investors need flexible strategy that can adjust to changing market conditions. Predictability analysis look at how big economic predictors affect the way returns spill over from the balanced portfolio to smart and green portfolios. First, the interest rate go up. Both smart and green portfolios are affected negatively. This means traditional portfolios become less effective and investors prefer to put their money into growth focuses portion like AI and ESG. Second, inflation also has a strong negative impact on smart and green portfolio. When people expect prices to rise, they move away from traditional assets and choose options like ESG or AI that can better handle inflation. Third, market volatility and sudden ups and downs in the market has a big effect on smart portfolios. This shows that AI strategies react quickly to changes in market mood. Green portfolios, however, are not much affected, which show that they are more stable during short-term fear. 4. Economic policy uncertainty increases the return impact on smart portfolios, which means AI react quickly to news and policy changes, but it doesn't affect green portfolios much, which show that they are more focused on long-term goals and less affected by short-term issues. Fifth, equity market uncertainty has a negative effect on both smart and green portfolios. This means that when the stock market becomes unstable, investors move their money into strategies that are either quick to adapt like AI or steady and reliable like ESG. Sixth, during infectious disease outbreaks like COVID-19, smart portfolios respond positively, showing that AI reacts fast to market fear and news. Green portfolios react negatively, showing they act as safe havens where investors go during big health crises. 7. The climate risk show a strong negative impact on smart portfolios, meaning AI strategy decouple from traditional returns when climate momentum rises. However, green portfolios show a strong positive effect, suggesting ESG investment move more closely with traditional market during period of high climate awareness. This highlights a clear divergence in how AI and ESG respond to environmental risks. Lastly, the geopolitical risk index significantly reduced return spillovers to both smart and green portfolios. This indicates that during wars or political tensions, investors shift capital away from traditional assets and into thematic strategies for safety or liquidity. In conclusion, these 8 predictors show how different economic and global events affect smart and green portfolios. While smart strategies respond quickly to short-term events, green portfolios are more stable and long-term focuses. Together, they offer different strengths depending on the type of risk, helping investors build more flexible and resilient portfolios. This study offers clear guidance for financial decision makers. For investors, both smart and green portfolios provide diversification during inflation and interest rate hikes. Smart strategy requires active sentiment tracking, while ESG portfolios are more suited for long-term, stable investing with a sustainability focus. For risk and fund managers, smart portfolios should be used for quick, data-driven responses, especially in volatile environments. Green portfolios, on the other hand, serve as defensive assets during crisis. Managing both requires tailored tools based on how each responds to different economic and geopolitical predators. For policymakers and regulators, the growing use of AI in investment highlights the need for greater transparency and oversight of algorithmic models. Likewise, the effectiveness of ESG investing depends on having standardized, forward-looking ESG metrics to ensure consistent regulation and investor confidence. In conclusion, by incorporating macro-financial predictors such as geopolitical risks, interest rate, inflation expectation, and so on, the study provides valuable insight into how smart and green portfolios react to economic shifts. This finding help improve portfolio planning, risk management, and policy decisions in today's more complex financial world. That's all for my presentation. Thank you.